a few weeks ago, I was working with a client who gave me a call and they said, hey, you put us in our house a year ago. We really appreciate that. But we're getting all these things in the mail about refinancing. Some of them are probably too good to be true. As we started going through them, yes, most of them were too good to be true. But we started discussing, yeah, you were at a great rate then, and rates are still really good today. You're early on in your amortization schedule, which means you haven't paid much of your total interest. You've only paid a year's worth. So what if we said, rather than you looking to do just a refinance, what if we took advantage of the increase in the property value that you've had over this last year, which has been really rapid in their area? And we said, let's pull some cash out of the house to pay off some of the high interest rate debt that they had. And so we took down all the credit cards they had, all the student loans, and we said, which one of these do you want to pay off? And we put together this total cost analysis I'm going to show to you. I'm David from the Cramm group here at Home Mortgage Alliance. And what you see in front of me is a total cost analysis that we did for them. Here's a couple of real key details that'll give you the high level overview very quickly. Number one, the rate when you looked at the total blended rate, which is all their credit cards and their student loans and all that, they had most of their credit cards about 12%. So the total blended rate over the mortgage and all of those was about 3.5%, just a little less. Their property value was $890,000. It had gone up $100,000 in value, a little over that actually, in just over a year. So a huge increase in value. We also didn't have to order an appraisal, so they didn't have to go through that extra cost and all the rest of it. So we said, what if you took as much cash out as you could? What if you took just a little bit of cash out? And what if you took and just targeted just the credit cards that they were most wanting to focus on? So we said, all right, what if you did cash out and very little payoffs? Great. If you had a rate of about 2.99%, it'd save you more, and you'd be in good shape to refinance, having lowered your mortgage payment and having lowered all those credit cards. Save you $520 a month. You would put that towards buying a new car, which in this case, they were thinking about having to buy a van. Then we said, what if you paid off more debt? So they looked at everything they had and said, let's try to put all in as best we can. That'd save them about $1,600 a month. And then we said, all right, what if maybe we brought the interest rate down a little bit, tried to pay off some debt in a little different combination? 3 1/8 was our interest rate. We're saving them now $1,800 a month. As we worked through those different scenarios, they were saying, some of these I'm going to pay off on my own, some of these I'm not, so I'm not going to worry about them. Then we focused in on which ones are the most important to you and which ones do we want to ensure that you get paid off and give you the best bang for the buck. But I said, is your monthly cash flow tight? And that was a critical question. And what the answer was, no, actually our cash flow has been fine. We feel pretty comfortable paying our bills. We're not tight at the end of the month. Great. What if we took then the same payments that you're making every month and we said, let's put that money into the house, keep paying the same amount each month, but pay it on your mortgage. You get the 3 1/8 interest rate. You don't get any savings in your payment, obviously, because you're putting that money you were putting on your credit cards into the mortgage. But now check out this. Their mortgage is paid off in 12 and a half years. So we went from a 25 and a 30-year term, which is what we were talking about, down to a 12-year payoff. So they'll be mortgage debt free before their first kid is out of high school, and they'll have paid off all of their high interest rate debt, and their payment is the same as they have outgoing each month. That is the advantage of using the equity that's in your property and these rapidly increasing values to your advantage, and doing it refinance early on in your amortization schedule so that you take advantage of the best savings in the interest over the long term. If you look at the interest in savings, their interest savings actually goes from $340,000 in interest, which they were planning on paying on those other cards and on their mortgage, down to only $142,000. So we've saved them $200,000. I call that a pretty good phone call for them in terms of refinancing and looking at other ways to utilize the money going out of their account each month and to apply it towards the best way to get them debt free. If you'd like a total cost analysis to help us give you some tools that can analyze your situation to pay off things and get you out of debt sooner, that's what we're here to do. So let us know. We're here 7 days a week. Thanks so much.